Hello and welcome to this very special edition of Financial Fitness Fridays. It's the cost of living crisis special edition about mortgages. Obviously, yesterday, the Bank of England put the interest rates up yet again. There's probably more to come, who knows? And it is driving a lot of stress into people because they don't know exactly what's going on. So what we're going to do today is I'm going to be running this session for half an hour. I have a special guest. Amongst other things, he's a fantastic mortgage specialist. His name's Hendrik, Olivier, works with us. And we're going to chat. I'm going to ask some preset questions from him for the next half an hour. And then at the end of the half an hour, you're free to go. Or if you want to, you're very welcome then to stay on for questions, for Q&A, for as long as it takes, usually 15, 20, 25 minutes afterwards. But interest rates are really important. You know, we've got the cost of living crisis, energy bills and inflation affecting the way we, our lifestyle. And, we did some maths on this recently, and we looked at a typical £30,000 a year person. Their typical expenses are up by £150 a month. But with a basic mortgage, with a typical mortgage, that is going to be eclipsed by the increase in the interest rates. And whilst it's a worry for a lot of people, for sure, most people are on a fixed rate. They've got a bit of time to get ready and plan for it when their fixed rate runs out. To put it into perspective, when I first bought a house, going back to about 1989, interest rates were about 15%. So it's been very low for a very long time. And I think the media does do a lot of scaring of people. They can sensationalize the news, and they make people worry very much, and that worry comes from just a lack of knowledge. So today is about giving you as much information as we can to give you knowledge, because when you've got knowledge, you've got power. Knowledge is power. So I'm going to start by introducing Hendrik, who's not going to turn up yet, but he will do in a minute. He will be answering this first question, and that first question is: first-time buyers and buying property, is now a good time to buy a property, or should I wait? Over to you, Hendrik.
I think we need to answer this question. You really need to think about your own personal circumstances. People still need to buy, people need to move. That doesn't change. We need to just sort of forget about all the noise and think about your personal circumstances. Forget about all the rates and what's going on. If you need to move, or you need to buy a house now, then you just got to face whatever is out there at the moment. So I think now more than ever is what you need is good advice. You need to speak to a good advisor who can help you navigate through everything that's going on, because over the last 10 years, the rates were very low. People knew exactly what was out there, what they could get, and there wasn't really much need, maybe so much, for advice. Whereas now, there are so many different things that we will probably cover today that needs to be considered as well. So, there's no easy answer to this. I think we shouldn't try and time the market and say, well, maybe wait a little bit longer. You really need to try and fit this around your own circumstances. Think about your motivations for moving or buying, and whether it's beneficial for you to do that now or not.
Yeah, I did read something the other day about America. House prices have gone down 2% this year. That doesn't feel like a crash to me. That feels a bit more like maybe a cooling off for a wee bit. Do you think that possibly something's going to happen here?
Yeah, I think a slight reduction in rates. I think what we're looking at is more so a correction of what's been happening over the last 2 years. During the COVID years, there was a bit of a mini boom in property prices, overinflated price. And I think what we're seeing now is a slowdown and maybe a correction of that. The problem, of course, house price is very much linked to affordability. And now with the increase of cost of living, affordability is getting harder, people struggling to afford things. But a house price crash, I don't see that happening. Yes, maybe a slight reduction, but I think it's very unlikely that we're going to see anything more than 5 to 10% reduction in house prices. So you may think, okay, I might want to wait a little while until that's happened. However, who knows when that's happened and gone as far as it's going to go.
Yeah, I think we've got to consider also the fact that, there is a shortage of houses in this country. Population is too big for the amount of houses that are available. So that supply and demand usually keeps prices going up. So, okay, and the media brings out all this information, they sensationalize things. Is it really as bad as they are reporting? I mean, and where do you see interest rates going over the next few years, for example?
Look, it's never really as bad as the media, portrays it to be. Like you said in the beginning, they need headlines and they sensationalize things. However, I mean, there's no denial that interest rates are now higher than they've been for a very long time. Like we've already said, inflation is at a 40-year high. And as a result of that, people are struggling. And it's just because of affordability that's now become a problem for most people as the cost of living is going up. So, regardless of what the media says, once again, I think it's just important to look at your own situation and understand, the facts and the drivers behind these things. Why is this happening and how that's going to affect you? Don't listen too much to the media. They're just trying to scare people, as you said before.
Yeah, I do notice sometimes they mention something that then corrects subsequently, but they don't mention it's corrected itself. I noticed that recently with, with the mini budget. A lot of those things are going. So they left us with all the bad news, but things have settled down and they don't quite focus on, when it's turned itself around so much. It doesn't sell so many newspapers, doesn't sell so many adverts, I suppose. But I think the big thing on most people's minds are there's people that are on fixed rates, and if they, I fixed my rate about a year and a half ago, so I've got 3.5 years instead of 5 years. So I've kind of relaxed about it.
Yeah.
A lot of people are coming to the end of their term. So there's people that probably got the end of their term within the next 6 months, and there's maybe those that are a year or so. So let's talk about those. Someone's got a fixed rate mortgage. They're probably going to see their rate go up.
Yeah.
Should they break the contract now? Should they pay the early repayment fees? Should they pay that charge, apply for a new fixed rate now? Just talk around that for our viewers, please, Hendrik.
Okay, so there's a few things to cover. Let's start with that then. If you asked me that question about 4 weeks ago, I would have given you a different answer. Just after the mini budget was announced, people all panicked, rates was just going up. And the feeling was grab the best rate you can get now, perhaps get out of what you've got now because it's just going to keep going and going up. Of course, since then, we've had a change in government. We've had retraction of all the tax cuts and all these sort of things. Sunak's been appointed Prime Minister, and that's brought a lot of more confidence back into the market, and that's settled things down a bit. So I've had a few clients who actually did exactly that. They've gone and done a calculation. How much was the penalty to pay to come out now? Grab the best rate they could, work that out over the next 5 years, and they've sort of worked out that was going to, work out cheaper for them compared to maybe fixing at a 5 or 6% rate now. However, at the moment, with the increased stability, I should say, for the time being in the markets, what we've seen is that the lenders have already started to bring down their fixed rates. Now, I know the base rate has gone up, but that's something different. Fixed rates are not directly linked to the base rate. And what we've seen over the last few weeks is interest rates slightly coming down, which is very encouraging. So therefore, I would be very reluctant to tell people to break their contract now, pay the penalties, because it really depends also on your personal situation. It's going to be different for everybody. It's going to depend on the amount of borrowing you've got left, and therefore the amount of your early repayment charges if you come out early, and also what's going to be available to you if you do come out. So you really need, once again, to speak to somebody who can help you and navigate through all the different products and do a cost comparison to see whether that is going to be cheaper for you or not, which in most cases probably won't be, because if you come out, you're going to immediately start paying a higher rate, plus all the extra costs associated with that. So like you said, I mean, someone like yourself, you're still on a good rate. It's probably going to work out cheaper for you to remain on that until the end. However, there are other things that we can consider, and the other question you was asking about is where are rates going? Yes, the base rate's going up, but of course that is to try and combat inflation. Fixed rate mortgages is something different, and that's got more to do with swap rates, which is the interest rates bank charge each other, and that's already been priced in, and it's widely accepted, I think, in the mortgage market that interest rates, fixed rates anyway, have already peaked, and as I said, they've already started to come down slightly. So while they are set to remain high, at least for the next 6 to 12 months, I think the feeling is that sort of towards this time next year, autumn next year, they should gradually start coming down. Now, most people are on fixed rates anyway.
So you saying you think it's not going to go up any further than where it currently is? Is that what you're saying?
Well, of course, I can't say that with certainty, but like I said, I think most people in this business will probably agree that the fixed rates are unlikely to go up over the next 6 to 12 months, and therefore I think it's maybe better to look at your options. It's still good, to speak to somebody and see what's out there, but breaking your contract and paying early penalty charges is possibly not the right thing to do right now.
I think the lesson from that Hendrik, then, is that you don't need to panic right now. Maybe 4 weeks ago we might have panicked a wee bit, but we don't need to panic. That's what you're saying effectively, I think, isn't it? Don't panic, but let's look at it calmly. Let's not make any rash decisions. Okay, and what about people that have got a fixed rate? You mentioned something to me when we're getting prepared for this with regard to talking to your existing lender. You might have another 3, 4, 5, 6 months to go yet, but could you explain to everybody what you were saying to me there? I thought that was quite powerful.
Yeah, so your existing lender, when we talk about maybe going into a new deal, if you're coming to an end, you should always check, first of all, what your existing lender offers you, because first of all, very often, especially at the moment, your own lender will offer you a better rate than what you can get on the wider market. And that's basically just to try and retain customers. They don't want people, panicking, jumping ship and losing their customers. So what they do is they offer you most of the time a better rate. What you need to keep in mind with that, though, is that they will only typically swap you to a better rate if you keep your loan exactly as it is, i.e., you're not trying to extend your term or borrow more. If it's a like for like, you just carry on with your existing mortgage stubs, keep paying that as it is. You should definitely look at that. But once again, it's still worth talking to somebody, an advisor who can look at the whole of market and say, look, what your existing lender is offering you is this. Perhaps we can find you something better. It's always, I think the key is now is a very, very important time to speak to somebody who can look at the market and who can help you through this, because what people want is a bit of certainty. We spoke about this before, you and I, about peace of mind that a fixed rate gives you,
Yeah, can I ask a question? So typically, if you're looking at, you talk to clients every day. So let's say somebody's got a fixed rate currently, and that's going to end in, say, 3 months. They talk to their existing lender. Now, we'll talk about the benefits of that in a moment, but they typically, where are they now and where are they going to be with those new deals? How much of an increase? What's the sort of jump on fixed rates they're going to experience?
Well, the problem is, like you said before, people are typically, most people who are on fixed rates now are fixed for 2 or 5 years. So the rates that people are now on is anywhere sort of between 1% and 2%, maybe a little bit lower, maybe a little bit higher. So anybody coming off a fixed rate anytime soon is going to see significant rises. There's no way around that, really. You're going to look at probably anything in excess. I'd say sort of between 5% and 6% is what you can expect now. And like I said,
can I just let's go back to that for a second.
Yeah.
I just want to get things in plain English. So, I mean, because people need to prepare for this, don't they? So we can't alter it. We can get prepared for it. We can plan ahead. We can engage with the problem. We can adjust our lifestyle. But at 2% going to 5 or 6%, we are talking about doubling our payments each month. Is that right?
That's right. I mean, example, my own mortgage comes to an end in end of March next year. I'm currently paying, I think, 1.44%, which I fixed for 3 years. The best deal that my own lender can give me now is going to just over double my mortgage payment come next year. However, that is still the best rate that is available to me at the moment. And just coming back to that point, when there's other advantages of staying with your existing lender, because if you do that, there's no need for you to go through affordability checks again, so no underwriting. So, which is at the moment is very difficult, because what a lot of lenders have done now to reflect the increase of cost of living, they have now increased their stress rates. So when they check affordability, it's much more difficult to get a loan than what it was two or 3 months before. I've had a few clients that I've been speaking to for a few months, trying to buy a house, thinking about it, sort of just getting everything in place. Did the affordability checks a couple of months ago, it was all fine. Now, with exactly the same criteria, their borrowing power is a lot less, purely because of the increased stress rates. So
it's really important then, that's really powerful, because you might end up not being able to move. Are there other costs associated with switching mortgage providers that you would say by staying with your existing lender?
Yeah, so first of all, obviously there's no underwriting, so there's no affordability checks. Also, and possibly not always the need to use a mortgage broker or an advisor. There's also no conveyancing fees or solicitor's fees, which when you go to a different lender, you have to go through the legal process. Whereas if you stay with your own lender, there's none of that. Now, the other thing that you need to think about there is, of course, some products will give you free legal advice, or free legals, as they call it. Others will give you maybe some cash back if you change to a different lender. But overall, staying with your existing lender is always going to be cheap and also easier and quicker. So it's important to see what they offer you. And the other thing as well with the lenders now, a lot of them have extended their window where you can choose a new product. Typically, it's between 3 and 4 months before your existing deal comes to an end. You can go in, see what they offer you, and secure that rate. However, a lot of them now extended that period to about 6 months. So what you can do is have a look at the best rate they offer you now, and you can choose that. And you can secure that rate, but you don't have to apply until your existing deal comes to an end. So the beauty about that is, if rates come down within that 6-month period, you can still change that. You're not bound to taking that rate. So it is definitely something that's worth looking at.
Is there anybody extending it beyond 6 months at all?
No, 6 months is pretty much the longest period you're going to get.
So it sounds to me like a wise move for anybody with a with a fixed rate that's going to end next year, for example. They would be very wise to talk to their existing lender right now, find the best deal that's available, secure it, and then have that parked ready for them when their other one ends, and they then have the option to take it, or they could shop around or see what other deals are available or go elsewhere. But at least they've secured that option. Is that what you're saying? That's
exactly right, yeah.
That's a really, really good bit of advice, I think. Really, really important. And I think advice around, you mentioned it a few times, so I'm going to go there on this because I've been in this industry a long time. I've done mortgages for years, but I do remember people try to do it themselves. I think that brings with it some dangers. So could you share with us a couple of experiences you're aware of where people tried to do it themselves online or whatever, but they messed up?
Yeah, you see, the problem you have is people always want to, I think it's just the generation we live in, everybody goes online and always tries to find the lowest and the cheapest deal for anything, really. And no different with mortgages. I often give people rates I talk to them, I give them a rate, which is the best for them. They then come back to me and say, oh, but I've gone on this online calculator and I found a better rate. Now, the problem with those online calculators are, first of all, they're not always very accurate. Secondly, they don't always have access to the whole of the market, which some brokers do, some others obviously don't. So that's important to remember. Not everybody has got access to the whole market. And more importantly, I've had people saying, but I see a better rate here. Why can't you have this rate? And the problem is people don't know what they're looking at. They're comparing an interest-only mortgage with a repayment mortgage. Obviously, big difference. So, things like that. So you have to be careful of what you're looking at, and you need to understand compare the right products with each other, right? I think it's very important in today's climate where affordability is the biggest problem for anybody trying to get a mortgage. We have to be creative. We have to think about using other income, things like bonus, commission, shift pay, overtime, whatever it may be. We can use these things. No online calculator is going to allow you to do or take all those extra things into account and also your personal circumstances.
Yeah, I think with an advisor, then they would look at it more holistically, I guess, rather than just that product, cheapest, best deal. It's actually, how does that fit in with your life, your expectations? And this is, this is probably, alongside pension pots, this is going to be somebody's greatest asset. And also, whilst they're paying for their mortgage, it's their biggest expense. So it's probably wise to invest a little bit of money in getting some expertise to get that job done as well as you can. What would typically, a good mortgage broker, we'll talk about what a good one is in a moment, but what sort of money would an individual have to invest in that service to make sure they've got a really appropriate arrangement for themselves?
Are you referring to fees for having mortgage advice? Yeah, look, everybody charges different fees. I think it's probably fair to say that an average figure is going to be anywhere between around the £400 to £500 mark to get good mortgage advice.
Okay, so it's like having your car serviced.
Yeah, and you've got to take into account, what that means for you, the value that you get out of that. For instance, once again, in this situation, there's a lot of problems that people face. I'll keep going on affordability because that is the biggest problem at the moment. We have to make it work for you. Of course, people struggling, they perhaps have missed payments on a credit card, maybe on a utility bill because they've been struggling. Now, typically your high street lenders, the big ones, they don't like these sort of things. So we've got access to specialist lenders who are becoming more and more popular now because they will look at your overall situation and they're much more flexible. They will look at maybe an impaired credit score, complex or unusual sources of income, all these different kind of things, bad credit, and we can get access to that and find a lender that fits in with your situation.
So people aren't limited to off-the-shelf products, I suppose. That's what you're saying.
Yeah, that's right. Because people would normally, they just want to go back to their own bank who they've got an account with and just go there because they know them and they think, well, I'll just take whatever they can. And they often say no because of this or this or this. So, going online and trying to find just a best rate, of course, that doesn't even mean you're going to qualify for that rate. There really is so much more to take into account at the moment. And that's why I think it's always just definitely the best thing to speak to somebody. I mean, normally you can just talk to somebody and, somebody's not going to charge you just to have a conversation, just discuss your situation.
So, I mean, I'm not suggesting this is not a marketing exercise for Foster & Dave or Second Sight. Anybody on this, is not a marketing exercise for us. Obviously, it's good for our PR. For sure, but this is not a market exercise for Hendrik. So I'm not suggesting for 1 minute you'll rush towards Hendrik to get some advice on this. But Hendrik, in order to get a good advisor, someone who's impartial, independent, who's experienced, where could people go to find somebody, an advisor like you?
Well, there are obviously sites like places like Unbiased where you can go. I think when you want a good mortgage advisor, it's very much like a good financial advisor, same thing really. It normally comes via referral. So if you know somebody who's had a broker who's done a good job for them, that's what I would normally say. Otherwise, somewhere like Unbiased is a good place to look.
Yeah, brilliant. Okay, well, look, I think we are at the 30 minutes. So those of you that have got to go, that's the end of. I'm going to run into Q&A now. So whilst I'm just going to do the regulatory stuff, I'm just trying to get my system to work. For some reason, I'm struggling with it. But if you could pop your questions into the Q&A right now, those of you that can hang around for another 10 or 15 minutes, we'll answer some of those questions. Those of you that have to go, thanks very much. I really hope you get something out of it. And check out the Financial Fitness Fridays YouTube channel. Financial Fitness Fridays YouTube channel. This one's going to be on there. I did miss the first couple of minutes because I got prompted by the marketing department to press record. I forgot to do that, but I'm sure we'll stick something on the front. But there's 23 other videos on there of other financial topics, done in the same kind of style as this. So please jump on there, have a look. So that's Financial Fitness Fridays. When you leave the session, by the way, also, you'll be taken straight to a feedback form. Please, please, please. We've given you half an hour of some good quality information today. If you could just spend 30 seconds giving us your feedback, okay? So when you come out of the session, you'll be taken to a feedback page. please give us your feedback. We'd like to know where we've gone wrong, where we've gone right, any constructive criticism. If you really enjoyed the session, then please let us know. It makes us feel good. Make sure we're going down the right road. So your feedback and scores help us fine tune and hone these experiences for people going forward. Anyway, in the meantime, let's look at the questions. There's lots of questions coming in. So I'm going to scroll down some of these and let's see what we've got. Everyone's saying they can hear me fine. We'll get past those. Okay. Right, so yeah, I thought this question would come up. Are there any or many caps and variable rate mortgages available? They feel like the right product right now, just off the cuff?
Yeah, there are some very good tracker or variable rates at the moment, and there is a good argument for perhaps looking at those, because if you can secure a good tracker rate, for instance, without any early repayment charges, it may be a good idea to go on to that, because it gives you flexibility. You can obviously, those rates are lower than the fixed rates at the moment, so you can pay that. And when fixed rates perhaps start coming down or start to get equal to what you're paying, then you could always switch to a fixed rate mortgage.
Brilliant. Okay, so there's another one here. Is it worth overpaying on your mortgage now if you're planning moving in, say, 5 years' time?
I think it's worth overpaying on a mortgage if, yeah, I think at the moment it probably will pay, but then of course the problem you have at the moment, it depends. If you're on a low rate, then you may as well do that to try and reduce your loan, because obviously when you come to the end of your term, your rate will most certainly go up. So if your loan amount is lower, it's going to cost you less. So I'd say yes, if you can, then do that.
Okay, another good question. My fixed rate ends January, 1.25%. That's been, I mean, that is phenomenal. When I actually paid 15.5% back in the late 80s, early 90s. So, I mean, that's phenomenal. But is a new fixed rate in January still a good idea, or is it worth going on to the standard variable rate? See what happens.
Well, standard variable rate is dangerous, because unlike the base rate or a tracker rate, which is linked to the base rate, you know exactly what that is, because that's what the Bank of England sets it at. Standard variable rates are pretty much whatever the lender decides it to be. So they tend to be very expensive. So I think it's better to maybe look at your fixed rate options, and once again look at what they offer you. They will probably offer you a much better rate than what it will be if you go onto the standard variable rate anyway. So I'd be very reluctant to just leave it to run onto an SVR at the moment.
Okay, thank you. Someone's mentioned, what's best? 2 years, 5 years, 10 years? What are you thinking? What would you recommend right now?
2-year fixed at the moment are still more expensive than 5 years, but only by a little bit. The thing is, though, we are expecting to see rates coming down in about 2 years' time to reduce. So I would be reluctant to fix for 5 years, because you're going to be paying that, say, 5 to 6%, whatever it may be at the moment, for the next 5 years. Whereas hopefully, I mean, of course, nobody knows, but hopefully in about 2 to 3 years' time, rates will definitely be lower than what they are now. And then, you know, you're going to be missing out for the next 2 years if you fix for 5 years. So it needs to be affordable. Whatever you do now needs to be affordable for you, though.
Okay, another good question. Oh, someone has got an even better rate here. They've had a rate finishing right now, 0.99%. I mean, I can't believe these figures. I mean, it is bizarre compared to what I used to pay. But I mean, I remember going back, 10-year fixed rates for 5, 6, 7% was unbelievable. That's what I was when I was arranging those, you know. But 0.99. Anyway, what are my chances of asking my current lender to extend from a 2-year fixed to 5-year fixed? Is it even worth asking the question?
Or to extend that rate?
Yeah.
No, they're never going to give you that rate now. No, they will only offer you whatever their available products are at the moment. That's not going to happen, unfortunately.
I've heard you can make a maximum payment towards your mortgage each year. If your fixed term's coming to an end soon and you do a large payment towards your loan, could that help you get a lower rate?
Yes, it can. So if you're looking at mortgage rates, what they offer, so they normally work in sections of, say, at 5%. So let's say between 60 and 65%, you'll get a certain rate. 65 to 70, you'll get a different rate, and so on and so forth. The higher you go, your loan to value, the higher the rate. So usually the smaller your loan is, the better rate you get. So if you can, say for instance, you're buying a house, if you've only got 20% deposit, you're going to pay a certain rate. If you've got 40% deposit, you're going to pay a lower rate. It's as simple as that. So if you can reduce your loan, and I've had some clients lately who maybe had some cash inheritance, or even people who get a tax-free lump sum from their pension, they've used that to reduce their mortgage by quite, 20, 50 grand, whatever it may be. And therefore, a smaller loan means a lower loan to value, and therefore better rates available to you.
Brilliant. Okay, we do have a lot of questions. We got a bit of time yet, so I know the answer to this one, but I'll put it out there. 3 months ago, my partner and I bought our first property and secured a 5-year fixed mortgage. Do we need to be worried or start preparing anything?
Well, if you've only just started on a 5-year fixed rate, look, you're locked into that now. What's going on in the markets now is pretty much irrelevant to you, I think, because it doesn't affect you. And like I said before, I think definitely in 5 years' time, we should definitely be in a better position than what we are now. Of course, no one can say that with certainty, but that is definitely where I see things going. I think there's no need for somebody in that position to have any concerns right now.
Good. I mean, I think they're very fortunate. If you got a fixed rate for 3 months ago, it's probably one of the best deals out there, and they've got it secured for 5 years. It's exactly what it's there to do. It's doing its job. It's giving you certainty in your life, so you don't worry. You've got more control. The more control you have of your expenses, the less stress you have. So from a financial well-being perspective, good for you. So anonymous attendee said here, would you please explain the connection between the Bank of England rates and mortgage rates, and why the advisors, think that this latest increase in Bank of England rates doesn't mean a further increase in mortgage rates? I think they're referring to fixed rates.
Yeah, that's what we said before. So the bank, look, you've got fixed rates, you've got tracker rates or variable rates. The variable rates or the tracker rates, they basically track the Bank of England base rate. The standard variable is slightly different. They do, but it's up to the lender to decide what they are. So the Bank of England rates goes up, those rates go up. However, fixed rates are not directly linked to the Bank of England base rate. Like I said, I think in the beginning, it has to do with swap rates, and that is basically the rates that banks charge each other to borrow money from each other. So that all went up because of the mini budget, and that's why the rates went up. Now that it's starting to come down and there's more certainty in the market, those rates have come down, and therefore, because the banks buy chunks of money off each other, which they then lend to us, and that's where the swap rate comes in. So that's why there's not necessarily a direct link. Yes, it is. There is a connection, but it's not directly linked between the two as it is with, for instance, a tracker rate. And I think this, with more stability, the rates for fixed rate mortgages will pretty much remain where they are for the moment and gradually start to come down. And it's not going to, the base rate is expected to go up even further over the next few months, maybe by a 0.25%, whatever it may be, but that's not going to have an effect on the fixed rates.
Good, that's really good. I think a lot of people will be surprised to hear that. So that's a really good distinction for today, as well as the one with securing an existing lender deal for the end of your current deal. That's really good. So there's a good question here, actually. My partner has a fixed rate for the next 3 years. We want to buy a larger place together and start a family. Will we need to completely new mortgage? Will moving before the end of the fixed rate terms have any negative or positive effects? I think the key thing is, will we need a completely new mortgage?
Well, if you're looking to move to a new and a bigger place, you can do something which is called porting, which means you take your existing mortgage and you take it to a new property. Now, there are some caveats to that, of course, where the lender has to be satisfied that the new property is, satisfied all their criteria and those so on and so forth. Also depends if you need to borrow extra money. They'll look at your affordability again. But there is that option, and we do that for some people because the important thing is that you keep your rate that you're on. So that's something to consider.
It's interesting because there's a question that's come here that mentions the word, they ported their own mortgage. So I think that's a new word for a lot of people on here. So that's transferring mortgage to new property.
Yeah.
Okay, so whatever. This one's a bit of a complicated one, it's a bit personal, so we'll keep that separate. Right. Now, you might know what this means, I'm hoping. Home improvements and EPC scores. Do these have a bearing on mortgages?
EPC scores, so EPC ratings we're talking about. That is basically the electricity performance certificate that you get,
right.
or the energy performance certificate. That is not for residential properties, that is for buy-to-let properties. If you want to get a mortgage for a buy-to-let property, the lender will want to see that the EPC rating is at a certain level, which are meant to go up as well soon, in a year or so. So it's not really applicable to residential mortgages, but yes, it does have an effect on buy-to-let mortgages.
Okay, here's a very powerful question, actually. This is going to happen to a not insignificant amount of people, I would imagine. What happens if you simply cannot afford the new rate?
Look, if you're really struggling and you can't afford, if it goes on to a new rate and you can't secure anything better and it is very expensive, you have to first of all speak to your lender. I'd say have a conversation with an advisor and see if there's anything that they can do for you. Let's say they can't, and the best rate that you're going to get is going to be unaffordable for you. You need to make contact with your lender. They have a legal duty to look after you and to come to some sort of agreement, and they always will, whether it's in terms of giving you a payment holiday, or perhaps what they do is extend your term, which will obviously bring down your monthly payments, or even just agree some sort of reduced payment. They will work something out with you, so don't bury your head in the sand. If you feel you cannot afford it, speak to your lender and they will help you.
Another good question, and I don't know why I didn't pick up on it earlier, actually, because it's so easy for us to slip into jargon and not realise that we're talking a completely different language to other people. But a gentleman here has asked, simple question: what is a tracker rate?
Okay, so a tracker rate is basically just a rate that is tied to the Bank of England base rate. So at the moment, since yesterday, the base rate is 3%. So typically, a tracker rate will be base rate plus, say, 1% or whatever. Let's say, so if you get that rate today, you're paying 4%, so it's 3% plus 1. But as the base rate goes up, if it goes up by another percent to 4%, you'll be paying 5%, because you're always going to be 1% above. And the same when it reverses. If the bank rate starts coming down, you're going to always be within that that difference between the base rate and the set rate. That's what a tracker. It basically just tracks the Bank of England base rate.
Yeah, and there's a very similar question. What's the difference in risks between fixed, variable, and tracker?
Okay, so a fix, obvious thing there. It's fixed. You know exactly what you're paying. It's not going to change for either 2 or 5 years, whichever you chose. So you've got certainty there. Of course, if you go for the tracker, you're exposed to any rise in the Bank of England base rate. Typically, you wouldn't go for more than a 2-year tracker, because you don't want that sort of uncertainty for 5 years. Now, a tracker can be very good if you know that something's going to happen in the near future. For instance, I have a few clients who have gone onto trackers because they know that they're going to move in about 7 to 8 months. But they came to the end of their mortgage. So they didn't want to fix now for 2 years, because if they came out after 8 months, they'd have to pay penalties. So we could put them on a tracker without any repayment penalties, so that after 8 months, you can just come out of that rate and then get a new rate.
Okay, we've got a bit more time yet, so we've still got a lot of questions. I knew we would. There's so many people on this session.
People coming.
Okay, where am I? I did find one a minute ago. Okay. Yeah, I mean, just any general advice for first-time buyers looking to move out of their family home?
Funny you say that. I have got a couple of tips for first-time buyers. First of all, you have to have a good credit score. And I know first-time buyers typically, well, not typically, but a lot of time people are maybe younger. and they haven't built up such a credit score or credit file as other people. However, it's important to try and keep your credit score and your credit file clean, as they say. What you have to be very careful of is payday loans. Lenders do not like seeing payday loans on a credit file. If they see that you're going to struggle. You also have to be careful with credit cards, missing payments, and also if the lenders see you're using your credit card but only paying back the minimum every month over a prolonged period, that is not going to count in your favor. Now, the opposite of that is, of course, a credit card can actually boost and increase your credit score if you use it often, but very importantly, as Martin Lewis always says on his show, you have to repay the full amount at the end of each month. Clear the bank. You can't leave it. That will boost your credit score. So that's a good thing that you can do. The other thing, of course, is that you should register yourself on the electoral roll wherever you live, because that's something the lenders will look at. That will boost your score. And other things for first-time buyers, I think those are the most important things. Your bank statements. Look at your bank statements for if you think you're going to buy over the next 3 months or so. Make sure that you don't go into a negative. Show positive income. What the banks want to see is that you can manage your money, that you have control over your incomes and outgoings.
It's probably worth pointing out there is government schemes out there to help people. So there's the lifetime ISA, where you get effectively tax relief on your savings as long as you use that for a deposit for a house. There's Help to Buy schemes where certain new builds you can have 20% or maybe 40% if it's inside London of a government loan, which is free of charge for 5 years. To get you going, and then you'd have to refinance that after 5 years. There's a load of other details around that one you need to know.
Just one and one more I forgot to mention actually. A product that not a lot of people know about, but I've actually used this with quite a few of my clients this year, is something called a joint borrower sole proprietor mortgage. So what happens there is it's normally used parents helping their children or whatever age they are to get on the property ladder. So typically the problem there is you're in your 20s or 30s, whatever it may be, you can't afford, your income doesn't satisfy the affordability. So you get a parent or both of them to go onto the mortgage with you. So the lender will take your parents' income into account as well as yours. So most times that will make the affordability work. The only caveat there is that the parent will have no legal entitlement to the property. Yes, they're on the mortgage and liable for the mortgage, but they don't have the property will just be for the child, basically. If that, I say child, but you know what I mean.
Offspring. Okay. Another good question. Would it be better to speak to the current lender's advisor or accept the rate through their online portal?
To be fair, most if you're already a customer, they will offer you their rates within the portal. So you log into that, and it will show you what the rates are available to you. If they do that, some lenders you will have to go via an advisor to get access to those. But a lot of the high street banks, HSBC, Santander, those sort of places, you can log into your portal yourself and see what the best rate. There's no point in calling them. They're not going to offer you a better rate than what you have available on your portal.
Yeah, another good question. This is getting more and more common now because we are working longer, retiring later. Is it still possible to get a 25-year mortgage if you're in your 40s or 50s?
Yes, so basically you can get a mortgage and the term will typically not extend, or they won't extend it beyond your 70th birthday. So if you're 40, then you can still get a 20-year mortgage. We're 40. No, what am I saying? 40?
30.
30. Yeah, sorry. Yeah, so
you can't even do basic maths.
Oh no, it's terrible, isn't it? So a lot of people ask this question, or they think that when they're in their 50s they can't get a mortgage because they think there's not enough time. But and it just depends really on how much time you have and whether. Obviously, the shorter the time, the more expensive the mortgage, the monthly payment's going to be. So yes, you can get a 20 to 25-year mortgage as long as it doesn't go over 70. However, that said, we sometimes do that. as long as you can prove to the lender that you will be able to afford the mortgage payments in retirement, i.e. via a pension or something like that, then that is possible to extend it beyond up to typically 70, sometimes even up to 80.
Okay, I think I've got time for one more question. I think, and then I think we're done. Quite an interesting one. I'm looking to buy my ex out of the property I'm in. It will increase the sum I need to borrow potentially above the loan to value my tracker is on. Do you think my provider will allow a change of rate without repayment penalties?
Oh, that's a bit of a, it's not straightforward situation. You have to do something called transfer of equity there, where you're buying out the property, and then because the problem you have then, because it now, if you take over the mortgage yourself, the lender will then say, right, only you are now liable, and you need to be able to prove that only you can fit the affordability for whatever the new amount is that you've now taken on. And often that's not doable because, just one income might not satisfy the new affordability criteria, especially at the moment where the stress rates have been increased.
Yeah, brilliant. Okay. So here's a good question. Actually, I think a lot of people may have this in their mind. Could they switch to interest only to make the payments affordable if they get a big rate hike?
Yeah. So I was going to touch on this, but I was reluctant because it's not traditional mortgage advice to say go on to interest only, purely because if you go on to interest only, you're not paying back your mortgage, right? You're only paying the interest on the mortgage, but the actual borrowed amount stays the same. However, if it will obviously reduce your repayment. So if it can help you in the short term, it's unusual time, so we have to be creative, like I said before. That could be considered. However, there are a few things that you have to, or criteria that has to be met for you to go on to interest only. For instance, typically minimum income, there has to be a certain amount of equity in the property. So what some people do, and what we've done certainly this year for people, is to go on a split repayment, where you keep some on repayment, but you put some of it on interest only, because that reduces your monthly payments as well. And that's worked quite well for some people. Once again, it's not traditional mortgage advice, but at the moment, it does help people to bring down mortgage costs. As long as you remember that part that's on interest only, you're going to have to start paying back that at some point. But maybe in 2 years' time, when the situation is better, then you can put everything back on a repayment. So it's definitely an option, but you need to speak to an advisor if you're going to consider something like that. Brilliant.
Okay. Well, thank you so much, Hendrik. I really appreciate it. So this is Hendrik Olivier from Foster de Novo, giving up his time, very valuable time. I know how busy you are right now. Your clients' phones must be ringing off the hook, So I have to do the regulatory bit before I finish. But if you're going to be going now, then you're going to be taken to a feedback form. Please, all we ask in return, give us a feedback. Let us find out where we're going wrong or where we're going right. Also, some people have mentioned, can we do this again? I think maybe it might be a good idea to review this and run this session again in the new year to see how things have panned out over the next couple of months. So I think we'll take that one away. Maybe we'll do that. So thanks for jumping on. Thanks in advance for your feedback. Really appreciate it if you could do that. I'm just going to read out, I've been sent by the marketing team the caveats so that we can actually get this on YouTube. So here's the caveat. Second Sight is a trading name of Foster de Novo Limited, which is authorised and regulated by the Financial Conduct Authority. This presentation is for information purposes only and does not constitute advice or personalised recommendation. Your home or property may be repossessed if you don't keep up repayments on your mortgage. This presentation is based on our understanding of the current and proposed legislation, which may change. All right, guys, thanks so much for jumping on. Have a great weekend. Good luck on your journey to financial well-being, and I hope you've got what you wanted out of today. And those questions we couldn't answer, we will endeavour over the next week or so to get some answers out to you, or maybe signpost you down the right road. But I think the key thing is here, the big message is here, don't try and do it yourself. It's worth spending a little bit of money to get the right advice from an experienced person. I think that's the key. Thanks a lot, Hendrik. Take care, everybody. Have a great weekend. Bye for now.